4월 트럼프 대통령의 관세 충격에 고점 대비 20% 하락했던 미국 증시가 손실을 모두 지우고 강세장 복귀를 눈앞에 뒀습니다. 월스트리트에선 최근에 랠리가 지속 가능한지 아니면 베어마켓 속 일시적인 반등일 뿐인지 논쟁이 뜨겁습니다. 투자업계 34년 베테랑 브라이언 벨스키 비모 수석 투자 전략가를 뉴욕 타임스퀘어 나스닥 본사에서 만나 뷰를 들어봤습니다. About your optimistic outlook about the U.S. equities, you remain very optimistic even though the very heightened volatility and the fading of the U.S. exceptionalism. What is your reasoning on that?
I know that control what you can control, not only in your life but in investing. And we believe, and we've written about this, that too many investors have based their investment decisions on exogenous events, what I'm calling news and tweets about tariffs as exogenous. Here's why. We don't know exactly when, how, and if these tariffs are going to be implemented, number one. Yeah. The majority of investors are treating and acting in a very binary fashion, meaning buy, sell. So they're selling based on the absolute worst news. Number three, they're also, we believe, applying their personal views and emotions on the President of the United States and what's happened in Washington onto how they're investing and how they're looking at things. I've always said in my 36 years doing this is that you should never let your emotions and fear drive your life, let alone your investment decisions. So this has caused these crazy valuations and crazy volatility back and forth. Now, do we believe that the U.S. stock market is still in a 25-year secular bull market that started in 2009? Yes. Do we believe that investors should control what they can control by kind of minimizing volatile assets but being more focused on those names when they go down, buying more? Yes. Do we believe that the U.S. exceptionalism trade is over? Absolutely not. We think a lot of that is driven by rhetoric, by negativity surrounding fear. Remember, the majority of foreign investors, non-U.S. investors, have been reluctant buyers of U.S. stocks for about 15 years now. They've had to buy U.S. stocks to perform, especially European investors or Chinese investors. Now, people have been excited because Europe has done so well the last 12 months or China's done so well. We'd be selling those markets because right now, because here's why. Because at the end of the day, stocks lead earnings, which lead the economy. Right? The stocks have already gone up. If you think about the best products and the best companies in the most diversified markets in the world, it's the United States stock market. So we would say this has been the next great buying opportunity for what we continue to believe is a secular bull market of 25 years in nature that started in 2009. It can go well into the 2030s.
So the recent rally, some are saying it's a bear market rally.
Of course they are. They're going to say they're bear market rally because people love to be negative. And the reason why they're saying bear market rally is a couple things. You got to be careful. The majority of people that do what I do pander to hedge funds. Okay? Hedge funds pay the majority of commissions on Wall Street. Hedge funds are bearish and they've gotten their you-know-what kicked all the way up. They did great on the way down. They've been late to get back on the market again. Oh, by the way, these are the same hedge funds that bid the market up in the fourth quarter after the election. Okay, so they're more momentum driven.
So BMO is not pandered by the...
I can't speak for all of BMO. All I can speak for what I do. Okay, for what I do with respect to my BMO investment strategy group, in terms of our forecast for the United States and Canada, we're not going to pander to the short-term money. We're going to be process-driven, discipline-driven from a fundamental perspective from the bottoms up based on both our bottoms-up analysis and our top-down analysis tells us not to get sucked into this negativity.
Of course, the U.S. The company's products is the best in the world, but many have concerns about the very heightened valuation. That is also true. What would you say to them?
We'd say this: valuation is not necessarily. Oh, by the way, not necessarily. It's the worst metric of forward performance. Number one. Number two. We also think, too, that, yes, the Magnificent Seven, in which we're technically underweight, one of the things that we have an opportunity to do, so we forecast the United States stock market, forecast the Canadian stock market, but we also run almost $11 billion of equities for Canada and the United States. And so we own a lot of U.S. stocks, a lot of Canadian stocks, and what we've said in public and in all of our writings that we are underweight the Mag 7, underweight the Magnificent Seven, and overweight the other components of the Mag 7 with those specific sectors. We are overweight other areas of the Mag 7 constituents that comprise technology, communication services, and consumer discretionary. Those are the three sectors that comprise the Mag 7. And we have been there since November. Okay, so it's been the right call, and that's why our portfolios are outperforming this year. So Oracle is a large cap technology company. Okay, and so we are, the Mag 7 in totality, we're underweight. And we're underweight mostly because we don't own any Meta. This is a stock picker's market, so that's one stock. So inherently we're going to be underweight anyway. But of the Mag 7, we're only overweight Apple, Amazon, and Google. That's it. The other ones were either neutral or underweight.
You don't really have any concerns about the tariffs and how they're going to impact the economy? And
We will have concerns about the tariffs when we know. You don't know what you don't know. And
so as of right now, you don't really think it's going to have a negative impact?
It's already had a negative impact from a sentiment perspective. That's why the market went down, because people are reactive and they'd rather react instead of doing the analysis, and they'd rather lead with their emotions with respect to what they think about the tariffs. Now, once we know what the tariffs are, then we can see what they are in terms of positioning on a stock-by-stock basis. But the tariffs are not going to change our view that U.S. stocks are in a big secular bull market. It may change the components of how we get through that secular bull market, but until we know what we need to know, we will not react to what's happening with respect to the tariffs.
So how about the very heightened rate uncertainty? Some are saying that the foreign buyers are not going to...
Some are saying that foreign buyers, because they have a vested interest. These are also people that have been short bonds. So at the end of the day, these are also people that lack perspective. Here's the perspective. The average 10-year treasury the last 75 years is 5%. 5. So BMO has learned that we're not going back to zero. So again, we're going back to normalized trading. We've said since November of 2022 that 10-year treasuries will likely find a range, for the most part, between 350 and 450, a trading range. Stocks would be in a high single-digit to low double-digit performance over the next 3 to 5 years. Same thing with earnings. Valuations would be contracting. Why? Because a valuation has a price in an earnings, or a price in a book value, or a price in sales, right? So people forget the denominator, numerator, denominator, the denominator can grow, and the price maybe isn't going up as much. Right? So let's say if the price is up 9%, but the earnings are up 10 or 15%, will the multiple go up or down? Down. It's just math. Yeah. And I think people's valuations are going up. I think it's just these statements, these reactive statements without doing the work. So again, I know some would say this and some would say that. These are the same people, some would say, that said we were going to go into a recession. How's that working out? Not very well. So I would be very leery of people making these fearful, negative comments with respect to the United States stock market, the United States economy. Again, these are the same people that said we were going to negative interest rates in 2020 as well. So again, let's have some accountability with respect to how and what they're saying. And I think you need to have a little bit more common sense and more, most of all, humility through this. And I think now's the time for that.
What is your best metric then to navigate this investing? We
wrote a report last week, and in our published report we have a few signposts on a short-term basis. Let's say the next 3 to 6 months. So 3 to 6 months short-term. Some people would say that's long-term these days. Intermediate term and long-term. Long-term, we're bullish. We think stocks are heading higher into low double digits average performance the next 3 to 5 years. Intermediate term, I think we're at new highs by year-end. Short-term, we need to see some signposts. Here's some signposts. Number one, we would really like to see companies provide guidance going forward and consistent earnings growth. That's number one. Number two, we'd like to see a less reactive market to every time we have some sort of a news event or some sort of a tweet or some sort of a rumor about a tariff deal or whatever. We need to stop being, okay? And then number three, we need to kind of get our budget straight too in the United States and see where that goes. Yeah. I think number three will probably come first because they need to do that. But again, I think politics have nothing to do with the absolute performance of the stock market. They can either enhance or detract the current performance, period. And I think too many people give politicians way too much credit.
But even though you say that, it is the nature of the market to react. Right now, they're reacting to the budget deficit.
It's a wonderful, wonderful comment. So here's my retort. It works until it doesn't work. So reactive investing, I think, is obviously now underperforming. And so those investors that are using that tool to be reactive, will quickly unwind that and instead be much more calm and much more, because greed begets greed. So investors will transition into more consistent and traditional trading patterns after they've lost either the jobs or their money in terms of how they're trading and reacting to all this stuff going on.
About the budget deficit, do you think that it's going to turn the market narrative to pro-market, or is it going to bring down the market because of the Moody's downgrade?
These are the same ratings agencies that missed the entire credit crisis, okay?
Yeah.
I would not buy a ratings agent come on.
I know.
Zero street cred, number one. Number two, in terms of, we've been running deficits here for a while, since the early 2000s. Again, I think we need to get our house in order, and I think that's what Doge was doing.
Mm-hmm.
And oh, by the way, it's no different than what President Obama was trying to do in his early start, or President Reagan. And so presidents have done this before, but because it's Donald Trump and everybody think it's Donald Trump's a bad man, it's going to be different, he's going to be a bully. So I think there's too much emotions and fear regarding that.
Okay. So there is no,
Nope.
nothing.
Nope.
Okay.
Nope. Thank you.
Thank you.